have a personally owned critical illness policy. So many times they come to me and they say, Sim, I have a personally owned critical illness policy.
That money will still go to the corporation. Every, guaranteed, it's going to get paid to the corporation tax-free.
And to make it simpler, somebody bought a corporately owned CI for 100,000.
So there is a tax opportunity there at retirement. And that's why that third option.
I'll be bringing each week a different guest with all the answers that you have the questions for. And this way you can come back to my podcast for any questions that come to your mind, and you can focus just on working, as everything else this podcast will provide you. Hi, welcome to Simple Wealth Wisdom Podcast. I'm your host, Sim Gakhar. Each week, I bring simple financial security ideas for successful business owners and professionals like you to help you build and maintain your lifestyle and legacy. I see a lot of you are always looking for tax advice, accounting advice, legal advice, estate planning, and investment advice. When I work with you all, I always work with a team of lawyers, accountants, estate planning advisors, and investment advisors. You usually hear everything from me. But now I feel through this podcast, I can bring all those people here who are my support system, and you can hear directly from them. This is the reason I started this podcast, where business owners and self-employed professionals like you can always go and get the ideas and answers to the questions regarding how they can protect and grow their wealth in the most tax-efficient manner. I'm sure each guest will bring a lot of value to you all. And today, I have Aris from Desjardins as my guest. Welcome, Aris.
Thank you, Sim. Thanks. Great to be here.
He is the Regional Sales Director with Desjardins. He joined Desjardins in 2014 and has 20 years of industry experience. Wow, that's a lot. 2 decades, right?
Yeah.
That's fantastic. I'm very excited to have you here, as I normally talk to you over the phone or Zoom whenever I have a client I want to discuss. But now this is the greatest opportunity where I'll ask you all the questions that my viewers, my business owners, and self-employed professionals want to hear from you. And you're going to answer them directly, so that coming from somebody who's my support system. So thank you so much, and I welcome you once again,
Thanks.
Aris.
Great to be here.
So let's start. Aris, I see a lot of business owners and self-employed professionals have corporately owned life insurance policies, but very rarely they talk about corporately owned critical illness policy. And my major topic for you today is critical illness. So I want you to tell us, why do they need corporately owned critical illness policy, and why is it important for self-employed professionals and business owners?
I think it's just to validate kind of what you're saying, Sim. Being on the road, working with advisors and clients, for a number of years, it's rare that I come across initially a business owner who's got the right type of CI, the right type of critical illness coverage. And what I overwhelmingly see is there's either nothing or not enough.
Yeah.
And why it's important is it's all about managing risk. And from a business owner's standpoint, what is the most important thing? Their business.
Yeah, absolutely.
So, and the other thing is, from a claim standpoint, there's a very high probability, a double-digit probability, that someone will claim on critical illness. And for those who don't know what it is, the major ones that people can relate to with friends and family: heart attack, cancer, stroke. Now, those are just 3.
Yeah.
But those are big ones. And in a CI contract with Desjardins, for example, we cover 26 illnesses. This is a long list of other items. And how that would work and why it's important is, in the event, and then I want to ask your viewers to maybe take a minute or two and pause and think about, what if I didn't go into work or I couldn't go into work for 6 months, 3 months, maybe longer. How does that affect me? How does that affect my business? What does that mean for my staff, my employees, my clients, the bank, my liabilities? So these are the things that we're all too busy to think about, but you need to really think about, is there an implication there, and what would that mean for me, my family, my business, going forward? Yeah.
So I loved how you said that. But I would like to ask you, if they have a personally owned critical illness policy, so many times they come to me and they say, Sim, I have a personally owned critical illness policy. I don't need a corporately owned. And that's where I want you to tell everyone, personally owned will take care of personal expenses. But corporately owned is for the business expenses, so many things, because you being the main person running the business, if you are critically ill, how that lump sum can help. So if you want to talk a little bit more on that, elaborate on that.
For sure. And so there's essentially 3 different ways of owning critical illness. And most people are familiar with that personal option, right? I pay with after-tax dollars, right? I have a policy. And if, for example, there's a claim on it, there's an illness and a diagnosis and a claim, they're going to receive that lump sum tax-free.
That's personally owned.
Personally owned.
Absolutely.
The other option, the second option, would be having a pure corporately owned CI policy where the corporation pays the premium. The corporation is also the beneficiary. So that same exact scenario, the claim would be made and the money would be paid back into the business.
Right.
Why would we want that? Why would we want a corporate versus a personal, or why would we want to consider both?
Right.
Well, the business has got its own needs, right?
Yeah.
And for a shareholder who's running a business, and if you're a realtor, you're a lawyer, you're a medical professional, you're running manufacturing, you don't have a lot of time, and you're typically actively involved in making sure your business is stable and growing.
Absolutely, yeah.
So that company needs critical illness because you, as the business owner, are running the entire show. And without you, everything stops.
Yep.
And if it doesn't stop, it will slow down significantly. So there's that need for the corporation to pay, which is what a lot of people like about corporate CI, the premiums for that policy, because as the key shareholder, you're so important to that business.
Very right. So you've said 2 options, but there's a third one also.
There's
you
a
said,
third
but
one.
before you go for the third one, I want to ask you, once they have a critical illness corporately owned,
Yes.
I want you to explain everyone what happens if there's a claim. Let's say somebody had a critical illness for $250,000, and the person who was the life insured in the corporation, let's say there were 2-3 partners, one of them had this, and the person had a corporately owned critical illness, and the benefit was paid to the corporation. Now, how corporation can use that money?
Well, that's exactly the point. And most people haven't thought about this, but from an illness standpoint, right? And I could speak to my father, for example. He ran a business for years and was diagnosed with cancer. There's a lot of costs that people don't understand.
Yes.
There's a lot of costs to run a business, right? Especially if you have staff, overhead, and so forth. So that claim would get paid to the corporation, and the key word is tax-free. So that money is on the company books, and it's meant to keep that company afloat, maybe even replace that shareholder when they're not able to do what they're doing, but just to keep the lights on. And it's something most people probably haven't thought about. Is that business going to be there while the shareholder is recovering? And that's really a hard question because we don't know what that claim is going to look like.
Staff needs to be paid. The rent needs to be paid. All the expenses need to be paid. So a lot of time, everyone thinks that, so many times people come and tell me, oh, I have a disability insurance, so I don't need this. Corporately owned critical illness policy provides a lump sum benefit to the corporation, and using that tax-free corporately owned policy claim money, business can continue to run and take care of all the expenses.
Exactly.
Yes.
Exactly. And the thing that a lot of people think about is, we think about our business, we think about our families. So you also have to remember that the family depends on that income.
Yes.
And the business valuation is also based on the revenue, the continuity of that business. So if that key person, or in a partnership, one of those key people is not working, there is a financial impact, and that's really what that is designed to do, is to protect that double-digit statistical reality that there is that risk. We're healthy now. We don't know what tomorrow looks like.
Nobody knows. One small diagnosis can change the whole thing. So now you've talked about number one is the personally owned critical illness. Number two, corporately owned. And there's a third option you said. So let's hear about that.
So the third option is known in our industry as shared ownership, CI. We have, Desjardins has really come to market with this product. We've had it in available for the last 20 years. But again, not very well known.
Yes.
So what is the difference between that structure? Is we have a product that's specifically designed for incorporated professionals. So you have to have a corporation in order for this thing to work properly. And it's a combination of the two. It's a personally owned policy and a corporately owned policy at the same time. So how does that work? Well, the corporation owns certain benefits. The individual, the shareholder, owns certain benefits to the plan. So just to explain, if there's a critical illness event, right, if there's a claim, that money will still go to the corporation. Every, guaranteed, it's going to get paid to the corporation tax-free.
On claim.
On claim.
Okay.
So that's win
One
number
part,
one,
yeah.
right? We've got the protection that we need, our company needs.
Absolutely.
Scenario number two that none of us are hoping for, along with scenario number one, we're not planning on that. But scenario number two is, what if we pass away? Well, we're going to pay out all of the premiums to the penny back to the corporation. Right? Okay. So there's no loss.
No loss. Okay.
If something were to happen earlier in the schedule, we would always pay a minimum 25% out of that CI amount. So they can take 1 month premium, life happens, we're going to pay out a minimum 25% back to the
So let me put it in simple words. Let's say somebody bought it for 100,000. I'm going to use the figure 100,000 to make it simpler. Somebody bought a corporately owned CI for 100,000. They paid, let's say, the premium of 1 year, $5,000, and the person died. Then the corporation, even after paying 1 year premium, will get $25,000.
Exactly.
That's a 25%.
Exactly. And that could happen after the first month. Of course, that's not what we're hoping for. What most people are motivated by is the fact that, we're not planning on getting sick. We're not planning on passing away. We're planning on staying healthy.
Absolutely.
So there's also a win in the healthy scenario. So as you're working, you pay premiums into the policy.
Yeah.
And both the company and the shareholder, when you decide to retire, and that's a moving target for a lot of business owners.
I'm going to stop you here for a minute, and I want you to just go a step back and tell the viewers why did you say that both are paying?
Okay.
Because we did not discuss that as yet, that corporation is paying a portion and personally a client is paying a portion. So let's go back to that a little bit.
The shared ownership CI contract is designed with two beneficiaries.
Yeah.
Two owners. Right?
Okay. We're talking about option 3. Yeah. The first one was personally owned, second one was corporately owned, and the number 3 is owned by both. Yes.
Right. The executive health plan, as that third option is Desjardins calls, is designed to still protect the corporation. So in the event of a CI claim, tax-free money goes to the corporation. In the event of premature death, that money will go to the corporation. But what shareholders are often looking for is a tax-efficient way of using both corporate dollars to fund their future retirement. And that's why the shareholder is involved in paying a portion of the premiums towards that plan every year. Now, if there are no claims, if there are no claims on the CI contract, all of the money is actually returned to the shareholder. So there is a tax opportunity there at retirement. And that's why this third option of owning CI jointly between the corporation and the individual is very attractive, especially for businesses that are generating large amounts of revenue, have very consistent earnings, and the shareholders are looking for a future, not only coverage, but they're looking for a future opportunity that's tax efficient. And that's where that return of premium comes in. So the cost, people think of insurance and they think of expense.
Yeah,
Right?
always.
What's it going to cost me? This is an investment. Right? And why I was saying it's an investment is with the third option, our executive health plan, there is no cost in the sense of you're not losing money that you're not going to get back. You're going to get back every dollar paid, even if you don't claim on the policy. When you retire, for example, you cancel the policy, maybe you sold the business, you got an offer you can't refuse, and all of the money, including the corporate amount that was paid and the shareholder portion that was paid into this plan over 15, 20 years, depending on your age and your retirement plan, is coming back out to you personally, and that's a nice tax opportunity for people. So the reason there's to go back to that central reason, why are we building the plan that way, is so both parties win. The corporation wins and the shareholder wins. But what's really, really important, and this is where Desjardins really leads in this market, is to make sure there's a fair sharing. We can't have our corporation pay for the entire policy and expect to get all of those premiums paid back to the individual tax-free. That's not going to work.
So is there a percentage, roughly? I know it's different for different age groups.
Exactly. Yeah. So
but on an average?
It really varies by age. I mean, typically the younger, the better, right?
Yeah.
So, I would say sweet spot would be 40s. It works quite well up to, I'd say, early 50s.
Okay.
But that percentage will change. I would say, for example, let's say it's 60% corporate, 40% personal for a young professional in their mid-40s. That would be, quite an attractive split. But regardless, your business owner is protected, the corporation's protected, and every dollar that's been paid is going to come back out to that individual in the future when they decide to retire. 15 years or any time thereafter, 100% of that money is returned.
That's amazing, because what I understand is that all that money that the person paid from the corporation was paid from the corporate dollars, which are the cheaper dollars, and when it came to your hands, it came tax-free. That means you never paid that tax.
Right. There is that tax opportunity, and what's really important is that clients sit down with yourself and understand what is the right way to put a plan together. To our conversation a little bit earlier, I have a personal owned policy, or I don't have a personally owned policy. Should I be considering corporate? Should I consider
Yes.
both? Should I look at the shared, executive health plan situation or structure? And there's no right or wrong answer.
Right.
There's no bad policy out there. They're all great, but they all do different things. So we really have to tailor them around your needs, your cash flow, and your situation to really make sure we're, putting it together right for your situation.
And at the right time.
Yeah, at the
Right
time.
age.
When we're healthy, hopefully.
When you're healthy. And so how flexible are these plans? Is the solution flexible for changing business and personal needs? Because, sometimes, somebody puts it in place and then the whole scenario changes. Yeah. Because there's a corporate dollar and there's personal dollar. So how flexible are these?
And that's really important, because we realize business changes. We just not too long ago came out of a very unusual environment.
COVID time.
COVID time, and that meant a lot of different things for different businesses. And so when we designed this plan, we had to keep that in mind. So a few features that would be important to a business owner. Of course, if the premiums become a challenge, we could look at reducing coverage. That's an option.
Okay.
If, for example, a business owner decided to sell,
yeah.
What if you got an offer you can't refuse? And it's just that right time to exit, maybe close to retirement, or maybe that competitor wants to buy you out. There is the option of changing the ownership and taking that policy over personally. That's available at any point.
Does that trigger any tax?
It would not. It would not.
Okay.
If the business owner also maybe, semi-retired, not going to the office 7 or 5 days a week, maybe 7 for some people.
Yeah.
I'm going in 2 days a week because I have a new partner involved. So
right.
we could look at changing the coverage amount, maybe, relinquishing part of that coverage that we no longer need. The other thing is, along the way, what may happen is we may hit a wall, right? It may be a bad year, or maybe we're in a very cyclical industry. Real estate would be a good example, right? A few years ago, real estate professionals may have been much busier than they are today with the economy we're in.
Yeah, rightly
so. So what we could do, the plan is designed with a unique feature where we could actually say, we're going to prolong premium. We're going to say, I'm not paying it this year. I'm going to pay it next year.
Is that the holiday
It's
time?
a premium holiday. So we could actually, it's available one time once the policies have been forced for 5 years. We could say, all right, we're not going to make the payment this year. We're going to skip a year and we're going to make that payment next year. And that could be a variety of circumstances. It could be, hey, I want to reinvest in my business. I've got an opportunity that I can't pass up and I need that money for something else.
Right.
Or it may just be, hey, we don't have the revenue we really planned on, so it's looking bright. We've got some orders in. We'll do it next year. So lots of different scenarios, and that's why it's really important to tailor that policy around the individual needs.
So is that a built-in feature, premium holiday?
Yeah, it's built in.
That's wonderful. That's really
Yeah,
good.
yeah.
Something that I didn't know.
Yeah, it's great. And also, if you are working with other professional advisors, you have your accountant, your lawyer, we do have a great tax package that you can share with them so they can better understand how this is structured and how it would work for you, the business owner. So that's an important part. We've been very consistent at updating our materials and making sure they do a great job at answering frequently asked questions. And that package is available to your other advisors who may be helping along with that decision.
I think this is something great, and the way you brought it up, I think makes a lot of sense. So how can this solution be a winning strategy for any business owner?
Yeah, it's a matter of just getting to know you and better understanding your business and your cash flow and where you are in your life. Do you want to retire in 10 years? Do you want to retire in 15? Is there a possibility you may start a new business in retirement? And there's many ways to structure it. We can use a holding company, which if you got that offer you can't refuse for your operating business. This policy's in your holding company, which would still allow you to keep that coverage if you perhaps started another venture in the future. So there's lots of different ways of structuring the plan so it remains flexible for your needs and flexible for your cash flow as well.
And what is I know you said it works best if you're in early 40s to late 50s. What if somebody I do a lot of them actually when they're 60 years old, 65 years old.
Yeah.
Would it work for them?
It would work. I mean, the key thing is every dollar that goes into the plan, you're getting out.
Yeah.
And where it works is really dependent on that business owner's time frame. And it's a moving target, right? Someone were to ask me, when are you going to retire? I'd say 65. I could retire at 58. I could retire at 71. We don't know in advance, but we're going to make our best educated estimate as to what we're looking to do. For example, I worked with one business owner, and he was in the consulting business, had a corporation, had absolutely no plans to retire. He would work when he wanted to work, 3 days a week, and planned on doing it for the rest of his life. So we structured a plan for him into his early 60s. We put the plan in force. And he planned on keeping the coverage for as long as he possibly could, because he knew if he ever stopped working, he could cancel that plan and get all the money back anyway.
So when can they take the money back if it's a permanent plan?
Yeah, 15 years, 100%, anytime after 15 years.
They can take 100% back.
100% back.
Wonderful. And everything is coming back to you tax-free in your hands.
To the individual, yeah.
Wonderful.
We ideally suggest and recommend to clients, I should say, that they take that return of premium when the coverage is no longer required. That would typically be retirement, but there are other circumstances where we no longer need the coverage. Our situation has changed.
And one last question that I want to ask you. I know we're running short with the time now, but I would like to ask you one question. A business owner has a holding company, operating company. Do you suggest it in the OpCo, or do you suggest it in the HoldCo, or anywhere?
Yeah, a lot of times the holdco, but it depends. Sometimes there is no holdco.
Yeah, for professionals. Yeah, a lot of them, they don't have holdco.
And maybe just the cost associated with setting up a new corporation and the accounting fees, it may have not been a decision that you've entertained. So we could, and we often will have the policy in the operating business. Of course, a holdco could be established in the future if that's the right thing.
And we can move it there.
And that could be moved over. And the holdco allows for a lot of flexibility in the future if there's another venture being started. So we've got that coverage in place, locked in. But there's no right or wrong way, so it really just depends on individual circumstances.
And if you're selling the business, then you don't have to worry about if it's in the holdco. So it can be both the places.
Exactly.
And you said it can be moved personally as well.
Exactly. And for a lot of business owners, who are tuning in today, they're very passionate about what they do, and that passion can change. So maybe into retirement, they've got plans to do something completely unrelated or related to what they're currently doing, and having that holdco and the coverage and the policy in force can allow them to kind of continue on in that new venture as well.
So my question comes to you is, full premium paid into the policy after 15 years, they can take it back as a return of premium rider. Is that inbuilt?
It's built in. So it's the way the policy is structured. It always has return of premium. It's always 100% after 15 years. But we strongly suggest that the business owner keep that policy in force while they're working, because we never know when a claim
You never know when the claim can come.
Yeah.
And can they take out the money partially earlier?
They can. So one opportunity would be possibly to reduce coverage, right?
Okay.
So maybe if we're no longer working, 40 hours a week and we're down to 20, and there's other people involved in the business and taking on some of those responsibilities, or maybe the premium's just not what I used to be able to afford, we could just look at reducing coverage. That's a very simple process to go through, so we could still retain some of that coverage and get some of the return of premium.
Very good. That's fantastic. That is really good. I love that. I think you explained it very well, and I thank you very much for everything.
Thanks.
And this has been very informative. Again, I learned a lot. I'm sure that my business owners and professional clients have learned a lot. And this is something that should be the part of everybody's portfolio, which a lot of people do not know the importance of that. Mm-hmm. And that's the reason I really wanted you to come and talk about that. So thank you very, very much, Aris. And if we need you again, we might call you again, because there's so much happening, and Desjardins has so many new things that have come up. And I know that we've only talked about critical illness today. So thank you so much.
Thanks, Sim. And again, just to be a bit of a broken record here for everyone tuning in, I highly suggest take a few minutes, call Sim, talk about your individual circumstances and what plan's right for you.
Thank you so much. And that was another episode of Simple Wealth Wisdom Podcast. Please let us know in the comments below what you like the most about this podcast, and if there's anything else you want to see or ask, and I'll make sure to bring that to you in our future podcast. Watch for us again next week. Until next time, stay safe. I'm Sim Gakhar. Take care.